Okay, how do I do this? Like this? Should I open my mouth wider? Is that good? Come on, give me more clicks. Oh, didn't know I was recording. How you doing? Oops. Hey everybody, welcome back to Whiteboard Finance. My name is Marco and I'm here to help you master your money and build your wealth. In today's video, we're going to be talking about how to profit from upcoming massive inflation. If you've been following my channel over the years, then you'll know that I've been making videos for years about inflation before it was the cool thing to do. I still get direct messages on Instagram and Twitter to this day from people telling me how my savers or losers videos have made them thousands of dollars instead of keeping that money in the bank. So at the time of this recording, inflation is at 7.04%, its highest since 1982, and core CPI is just above 5%, its highest since 1991. In this video, we'll touch on 3 ways to invest if you want to profit from the inflation we've been seeing over the past year and some change. Stay tuned. Okay, so number 1 is real estate. Real estate is one of the best wealth building tools throughout human history, especially during times of inflation and especially in the United States. Let me explain why. Americans have access to something called a 30-year fixed rate mortgage. This means that your interest and your payment will be fixed over the course of those 30 years until the mortgage is paid off. Most other countries in the world don't have the option of this because they have adjustable rates, meaning that the interest is not fixed. So how would a 30-year fixed rate mortgage allow you to profit from inflation? So real estate has historically at least kept up with the rate of inflation throughout history, depending on where you live. It is a highly financialized product and it is closely tied to the financial markets overall. In times of inflation, your property will typically keep up or outpace inflation, as we're seeing all over the country over the past few years. So let's take a look at Willie. Willie's a subscriber of Whiteboard Finance, and he wants to buy a $100,000 house just for easy numbers. And yes, $100,000 homes still exist in the Midwest. Hold on, let me laugh at Midwest real estate prices for my incredibly large custom-built brick house that costs less than a porta potty in California. I have so much room and so much space, and I'm so comfortable. But the weather sucks 5 months out of the year. So let's get back to Willie, who decides to put down 20% on this home. So for all the viewers out there that are math geniuses, what is 20% of 100,000? Well, that's obviously $20,000. So as I mentioned in the intro of this video, inflation this year is right around 7% according to CPI, even though we all know it's much higher than this in real life, but let's just call it 10% for easy numbers. So we'll say consumer price index is 10% year over year. It's really at 7. CPI is a very debatable number. No, debated, sorry, not debatable. Depending on the metrics the government uses to actually calculate this number, but I promise you it's much higher than 7. So let's just use 10 for this example. So historically, Willie's house will have kept up with inflation, if not gone up more in price, making this home worth $110,000. It's $100,000 plus 10%, right? So now keep in mind, there is no gain in purchasing power here because inflation is 10% and the house price went up by 10%. This is the same as if Willie got a 10% raise at work and the price of everything he buys in life goes up by 10% because of inflation. This is a net gain of 0% in purchasing power. But this is the beauty of leverage when it comes to real estate. Remember that Willie only put down $20,000 for a $100,000 property while still gaining an additional $10,000 in equity by inflating his original $20,000 to $30,000. So you take this 10 grand gain in equity plus 20 grand here, that gets you 30K, okay? And keep in mind, this is short term. So if Willie kept his $20,000 in the bank instead of buying the property and using leverage, he would have gotten eaten alive by inflation, making him lose purchasing power, AKA savers are losers, okay? Been talking about this for years. If he would have kept his money in something that keeps up with inflation at 10%, his $20,000 would have become what? So if he would have kept this 20 grand and it makes 10% and the same time this house equity made 10%, what's 10% of 20 grand? 22 grand, okay? Made $2,000. So by using leverage and investing in real estate, he was able to make 5 times more, $10,000, 5 times more than 2,000, by having his money in the property. Now, obviously, leverage is a double-edged sword, and Willie needs to be careful in what he's buying or investing in, but getting a fixed-rate mortgage in a property that at least keeps up with inflation is a way to profit in the short term. Okay, so we're going on to number 2, which is real estate long-term. The first one was a short-term example. So that was talking about leverage and real estate to increase purchasing power via inflation. This next example is going to show you the long-term effects of sustained inflation. So here's a fun fact. 80% of all US dollars in existence were created in the last 24 months. Yes, let me repeat that. 80 cents out of every dollar in existence was created over the last 2 years. So what does this mean? More money in circulation means that your dollar will be worth less and less over time. It will be able to purchase less and less goods and services. Savers are losers. This is inflation. So here is a simplified example. Let's go back to our friend Willie, who bought that $100,000 house and put $20,000 down. This means that his loan is fixed for 30 years with a principal of $80,000 remaining at day 0. So for those of you that are watching on a cell phone and not on a big screen TV or monitor, this is 2022, the year 2022. This is his debt, which is what? $80,000, okay? And then this is 2052. This is a span of 30 years. This is his mortgage. His mortgage is fixed, and we'll talk about this in a second here. So if Willie's employer keeps giving him raises over these 30 years that keep up with the rate of inflation, he's paying off 2022 debt, which is that 80 grand, the year at the time of this recording, with future dollars that are actually worth less, but they have a higher nominal value, a higher number to them. Willie's purchasing power isn't increasing, okay? His pay is going up with the rate of inflation, but his debt is staying the same. So his goods and services cost the same, whether milk is $1 in 2022 or $5 in 2052, and his pay is $1 in 2022, and his pay is $5 in 2052, it doesn't matter. He's still buying the same amount of milk. The number is going up, but the debt is not. So Willie's purchasing power is not increasing. This goes back to the original example of him getting 10% raises to keep up with the inflation, even though the cost of goods and services have gone up by 10%. It's a wash, do you understand? However, the number that he is actually getting paid is going up to keep up with inflation. This is his income, okay? While the debt is staying the same. 80 grand is 80 grand. It's a 30-year fixed rate mortgage. That stays the same from 2022 to 2042 to 2052, okay? So the difference between your debt payments and your income after inflation is your spread or your profit, okay? It's the difference between these two numbers. So if this debt, say for example, is a 2.5% mortgage and Willie's income is going up 10% a year, this is a spread of 7.5%. Makes sense? So this is why real estate investors and real estate developers are typically cash poor and debt rich, because historically inflation has helped to pay down their debts. This is obviously assuming that the property cash flows and can sustain its current debt service. But you're gonna ask, hey Marco, this all sounds too good to be true, right? Well, yes, there's a couple of caveats to this. The fixed interest rate needs to be significantly lower than not only the rate of inflation, but also the rate at which his income is going up. So if he has COLA, cost of living adjustments, and they're keeping up with that inflation, he's good. The second thing is that I'm making a big assumption by thinking that your employer will actually keep your pay consistent with the rate of inflation. If inflation, for example, is 10% and you're getting a 2% raise, you're actually losing 8% in purchasing power for the year. Makes sense? So there are many examples of people being able to pay off real estate after a hyperinflationary event. If you look at instances throughout history like Germany in the 1920s or post-World War II, this happened. Countries that went through civil war like Yugoslavia in the late 80s, early 90s, they had this happen. I've personally held 100,000 dinar bills in my own hand, and it seemed like monopoly money or play money at the time. My barber is Lebanese, and he was, shout out to Nick, he's Lebanese, and he was telling me stories of his uncle paying off his house after their inflationary periods that just happened. Very interesting. Okay, when a currency is inflating or under pressure from outside factors such as war, for example, investors turn to physical goods, AKA commodities. Commodities are typically used in the ingredients to creating other end products around the world. So what are some examples of commodities? Commodities can include things like gold, silver, oil, natural gas, corn, livestock, soybeans, etc., etc. In non-inflationary times, commodities are typically used as a hedge in modern portfolios. I would personally never hold commodities in my portfolio, especially during a time of growth like we've seen over the past 13 years. Commodities typically have a low to negative correlation to traditional assets like stocks and bonds, okay? Low correlation. This is why commodities have basically underperformed over the last decade or so. But since we've seen so much money being pumped into the system, you can see the rise of certain commodity classes exploding over the past year or so. I think some of these also have a lot of room to run if inflation stays persistent. So here are some examples of commodity ETFs. URA is a uranium ETF that is up 42.4% over the past year. USO is an oil ETF that is up 70.55% over the past year. Gold, ticker symbol GLD, this is an ETF which I would not recommend buying. So if you're gonna invest in gold, you should invest in physical bullion. Owning a gold ETF defeats the purpose of owning the actual gold itself, in my opinion. This is the same as owning a Bitcoin ETF. It defeats the purpose of the product. So people direct message me all the time and they ask me where I buy gold from because I have many videos on gold. And no, the answer is not jewelry stores. I've been buying gold and silver bullion from jmbullion.com for roughly 7 years now. I've always received the highest quality products and they ship super fast. I told GM Bullion that I'd be giving them a shout out in this video and they created a custom link for everyone down in the description below. Again, check out jmbullion.com and tell them that I sent you. Next, we have UNG, which is a natural gas ETF that is up 54.75% in the past year. And there's a million more examples of commodity ETFs I can give you, but these are just a few. So let's get on to my final thoughts to end this video out here. Okay, so now that inflation is becoming more and more talked about, I have a video called The Ultimate Guide to Inflation, which I came out about 8 or 9 months ago, for example. People are starting to realize like, hey, why do I feel like I'm not getting ahead in life? I've been working this, middle-class W-2 job. I feel like I'm on this hamster wheel, and no matter how many raises I get or how many cost of living adjustments I get, I feel like I'm running in place. Well, that's because everything is going up. Take a look at this chart right here. You can see all these various things going up, up, and up. Used cars are up 30+%. If you look at gas, if you look at oil, if you look at energy, all these things have exploded over the past year, year and a half. So I'm not gonna get into what's causing this. I'm not gonna get into geopolitics or anything like that. But my point is that follow monetary policy, learn to be a critical thinker. This is not a channel with the rocket ship emojis and all that stuff. This is to empower you to become a better investor. So what I wanted to end this video with is my thoughts in terms of what will be a good hedge eventually. Gold has typically been a great hedge against inflation. You're not necessarily gonna profit from it, but it has historically proven to preserve wealth over time for thousands of years now. Back in Roman times, you could buy a really nice tunic for 1 ounce of gold. Fast forward to 2022, you can buy a really nice suit with 1 ounce of gold, okay? It's about, I think like $1,500 at the time of this recording. If you look at other versions of gold, look at Bitcoin. In my opinion, Bitcoin is digital gold. It's digital gold 2.0, or it's gold 2.0. It does all the same things that gold does, except more, and it's better suited for the 21st century. If you look at things like fancy watches, like Rolexes, some people make fun of me because I wear a Rolex in these videos, and they say, oh, that's a middle-class wealth trap. No, dummy, it's actually a proven hedge against inflation that I can put on my wrist and fly to anywhere in the world, God forbid if something were to happen where I currently live, right? It's a preservation of wealth and value. Look at collectible cars, sports cars, naturally aspirated engines, stick shifts. These will absolutely explode in value over the next 10 to 20 years. Once internal combustion engine vehicles become outlawed and everything goes EV, car guys such as myself, they'll be paying through the nose to get a nice manual Porsche, a nice stick shift, 911, Cayman GTS, Cayman GT4, that kind of a thing. So trust me on that. I made a lot of money flipping cars. So once you start thinking outside the box, you'll really start to understand how to profit from inflation. What we talked about today is the easiest ways to do it through real estate and commodities, but there's a million ways to do it if you can find your niche. For me, it's cars, collectible watches, things like that. Thank you so much for watching this video. As always, give it a like if you can, share the video. Shout out to jmbullion.com. If you're looking for gold or silver or platinum, I highly recommend you check out jmbullion.com. Thank you so much and have a prosperous day. All right, I gotta get better at this. How wide do I have to open my mouth to get views? Those are so stupid. Hey, anybody doing those thumbnails, they're insulting your intelligence.